Hello, beautiful people. Welcome back to Finance with Mary. If this is your first time here, you are highly welcome. And to my returning subscribers, thank you for always choosing to grow financially. And today, we will be treating a mind blowing topic, which is before you borrow money in Nigeria, the complete truth about loans, interest, collateral, and financial survival. Today's topic is not just education, it is protection because to collect loan is very sweet, but paying back, that is where many people cry silently. Stay with me till the end because this video will save you from future regrets. Thank you. Let me tell you a short story. I once worked in a bank. One day, a woman walked into the bank. Her shop is almost empty. Customers have stopped coming because the shelves are dry, she says. Please, I need 500,000 naira. Once I stock my shop, everything will change. She is hopeful. She is confident. She believes this loan is the answer to her problems. The loan officer asks her for BVN, account statement, utility bill, guarantor details, passport photo, all necessary transaction books, and other requirements. She provided everything quickly. 2 days later, joy, excitement, new goods arrive, shelves looks beautiful again. But 3 months later, sales are not moving as expected. You get, then repayment starts and reality begins. The question is, what is loan really? A loan is a borrowed money that must be repaid with interest within a specific time. Loan is equal to principal, that is the lump sum you collected from the bank, interest, that is bank gain for borrowing you the money, plus time, that's time pressure, plus legal obligations. That's the meaning of loan. It is not help, it is not blessing, it is not free capital, it is a contract. And contracts don't care about your emotions. This you must really understand. Let's talk about understanding interest. This is where many people get trapped. Let's break it down slowly. If you borrow 500,000 naira and repay 700,000 naira, the extra 200,000 naira is interest. But here is what many people don't know. There are different types of interest. We have the flat interest rate and the reducing balance rate. Flat rate is often more expensive because interest is calculated on the full amount for the entire duration, while reducing interest rates or reducing balance interest is a method where interest is calculated only on the remaining unpaid loan amount, not on the original amount you borrowed. This means as you keep paying back the loan, the amount you owe reduces and the interest charge also reduces. Now, simple example, if you borrow 500,000 naira, month one, interest is calculated on 500,000 naira. After repayment, maybe you now owe 450. Month two, interest is calculated on the 450. Then it keeps reducing and reducing. Why is it better than flat rates? With reducing balance, you pay less total interest. It is fairer. That's why when taking a loan, it is always good to ask, is this loan calculated on reducing balance or on flat rates? It's very important so that you won't get trapped. Hidden loan charges. This section is very important, so pay attention. So, apart from interest that's being charged on this loan, there are other charges people ignore. Let me explain them. For example, we have the processing fee. This is the administrative cost charged for handling your loan application. So, as they are processing the loan, they are charging you for processing that loan. It's not free. It is often deducted before the loan is given to you. For example, if you apply for 500,000 naira, Processing fee is 20,000 naira. You receive 480,000 naira, but you repay back 500,000 naira. We also have the insurance fee. Some banks insure the loan in case of death or default. This fee is added to your costs, that's your loan costs. We also have the legal fee. If collateral is involved, legal documentation costs money. Lawyers must prepare agreements. You see? We also have late payment penalty. If you miss a repayment date, penalty is added and penalty can accumulate quickly because you are being charged on a daily basis for failure to pay. We also have early repayment penalty. Some banks even charge if you want to finish your payment on time, you get. So always ask questions. Is there penalty for early repayment? Is there penalty for late repayment? Ask questions so that you don't get trapped. It's very important. Now, let's talk about the psychological effect of loan pressure. you know this is serious. When business slows down, you start avoiding calls, you reduce communication, you feel ashamed, you feel fear, you are anxious, you may even lie to your family members. You may even want to, you say, God, what do I do? You start running away from your home because they will have to come. The loan officers will come to your house as early as 5 a.m. to wait for you till you wake up, you get, and even wait for you in your shop. So you start hiding and dodging and all of that. So all of this, you need to think very well before going into loan. Debt changes behavior. Money should give confidence, not anxiety. Let's talk about moratorium. In taking loan, there's also what we call moratorium. Moratorium means a grace period before repayment begins. For example, if you collect loan today, bank says start paying in 3 months' time. It sounds good, right? But listen carefully. Moratorium is not free. The interest during that resting period is usually calculated and spread across your repayment schedule. So you are still paying for that resting period. So if you are okay with it, no problem. But personally, the shorter the moratorium, the better because it reduces total accumulated interest. So you have to always ask. Now, let's also talk about collateral. What can be taken from you? The bank will always ask you to drop something tangible in exchange for your loan. Collateral is a security. It can be land documents, car, house, equipment, your house properties, fixed deposit. If you fail to pay, the bank can legally sell that collateral. Some people have lost family land because of some business loans. So read agreement carefully, shine your eyes. Don't sign because of pressure. Be careful. It's very important. So let's talk about guarantors. A guarantor promises to pay if you fail. So if you default, the bank will do what? Will call them, send them letters, and even mandate them to pay back the loan until the client has the money, to refund to the guarantor, you see. So possibly involves recovery agents. Imagine your friends being embarrassed because of you. Don't involve guarantors unless you are disciplined. You understand? Let's protect our friendship. Now, what are the advantages of loans? So, taking loans is not completely bad. So, let's balance it. So, loan helps to expand your business faster. It helps to grab seasonal opportunities, that is, buying in bulk to resell. You get. It helps also to buy machineries to equip the business. It helps in emergency situations, but only when calculated properly. Never borrow because of excitement or because you want to fund your expensive lifestyle or because you want to impress your friends. So, what are the disadvantages of loans? We have high interest rates. Most banks borrow from other institutions and they also want to make gain. You understand? Therefore, the interest rate will definitely be high. Now we have cash flow pressure. This happens when the money going out of your business is more frequent or heavier than the money coming in because of the loan you're always repaying. You get, is a challenge. Now we have collateral risk. You end up losing assets for failure to pay back your loans. They will come and the banks will come and grab your asset and sell them. Relationship damage. Your relationship with your friends, that's your guarantors, and your banks will be what affected. And thereby, if you need any soft loan or sharp loan, they will not give to you, or you will not have any guarantor to stand for you again when such situation arise. So you have to be very careful and calculative. So the last disadvantage is emotional stress. You are completely drained. You are running from pillar to post, looking for where to get money to repay back your loan. You're borrowing from one bank app to another bank app, or from one bank to another bank to pay your loan. No. Note, if your profit margin is 15% and interest is 35%, that loan is dangerous and deadly. Instead of borrowing from banks, the alternative ways to raise capital are: one, cooperative societies. Members contribute regularly. You can access loan at lower interest rates compared to banks. Two, contribution, ajo or esusu. You know the one I'm talking about. This is where you get save, as you get to save little by little on a daily basis, and also withdraw, at any time you want to add to your business. You can also join this rotating savings group, whereby a group of people come together to save. Then month one, A collect; month two, B collect; month three, C collect. It continues until everyone has collected. This system works well for disciplined groups. Number three, we have the partner investment. Instead of loan, bring someone as equity partner. Yes, they invest money into your business and share your profit. No fixed repayment is needed. Number four, we have supplier credit arrangement. Negotiate with your suppliers. They give you goods, you sell them, then you pay after agreed time, at the agreed time. Very powerful. You understand? This one, no stress at all. So number five is family equity support. So instead of borrowing with interest, allow family members invest and share profit. That is for reasonable family members. Number six is crowdfunding. Raise small amounts from many people. Number seven is pre-order system. Collect payment from customers before supplying goods to them. This reduces need for what? Capital. This is smart strategy. Now note, cash flow is king. You understand? Profit is different from cash flow. You may be profitable but have no cash at hand. Always calculate. Money in versus money out, that is cash flow. Loan does not fix poor financial management. So here is my last counsel, my final counsel. Loan is a financial tool like fire. Fire can cook a food, fire can bring down a house. It depends on how you control it. Do you get? So before borrowing, ask yourself this simple question: am I emotionally ready? Am I financially disciplined? Have I calculated everything? Do I understand the full cost of what I'm going into? Do you get? If you're not ready, then grow slowly. Peace of mind is also wealth. You get? If this masterclass helped you, like, share, and subscribe to Finance with Mary. Comment below. Have you ever regretted taking a loan? Let's learn together. Until next time, stay financially wise, stay disciplined, and stay blessed. Bye.